Hey everyone, welcome to Alpha Insights. I'm Jeff.
And I'm Asher. Great to be with you. We've got a lively market snapshot to chew over today.
Markets opened strong and the headline was a tech-led rally. The Nasdaq was up a little over 2% with semiconductors and software names doing a lot of the heavy lifting.
Exactly. Those sectors reported earnings that beat expectations, and that combination, good results plus optimism around artificial intelligence spending, really lit a fuse under the group.
When earnings actually outpace estimates, it gives investors confidence that revenue and profits are real, not just hope. Add the AI story, companies saying they're investing more. And you've got a recipe for higher stock prices.
Right, and AI isn't just a buzzword anymore. It's shaping capital spending plans. When CFOs signal they'll pour money into AI projects, analysts re-rate growth forecasts. That can lift chipmakers who provide the hardware and the software firms that build the models.
There's also an interesting dynamic with interest rates. The Federal Reserve has maintained a cautious stance, which markets heard as steady and careful, not necessarily loosening the taps anytime soon.
That's a key nuance. The cautious Fed generally means rates stay higher for longer than some investors hoped. That tends to be a headwind for long-duration growth stocks. But today, the earnings beats and AI optimism seem to more than offset that pressure.
So in plain English, normally higher rates make future profits less valuable today, which can punish growth names. But when those companies actually show the profits arriving now, it can counteract the rate squeeze.
Nicely put. It becomes a tug of war between fundamentals, like current earnings, and macro factors like rate policy. Today, the fundamentals won the round.
Switching gears, energy stocks were weak. The sector slipped on lower oil prices, which isn't surprising. When oil retreats, energy earnings outlooks dim and the stocks follow.
Yeah, lower crude tends to take the shine off energy names pretty quickly. For investors, that can be a double-edged sword. Cheaper oil is good for consumers and some parts of the economy, but it's a headwind for energy producers.
Healthcare and financials were a mixed bag today. Some healthcare firms posted decent results, while others missed. Banks and other financial companies are still wrestling with what a cautious Fed means for net interest margins and loan demand.
Financials are particularly rate sensitive. If rates stay higher, banks can earn more on loans. But if the economy slows or demand dries up, that benefit can evaporate. So, performance depends a lot on which banks and what their balance sheets look like.
Investors are also keeping an eye on upcoming economic data releases, inflation readings, employment figures, retail sales, because those reports will influence the Fed's next move and market positioning.
Exactly. Think of these data points as the roadmap for the Fed. If inflation comes in cooler or jobs soften, the Fed might become less hawkish. If the data stays strong, the cautious stance could stick around. Traders are watching closely.
So what should listeners make of all this? For starters, earnings matter again. Solid corporate results can push stocks higher even when macro policy is uncertain.
And don't forget sector rotation. Today's winners can be tomorrow's laggards. Tech got the spotlight today thanks to AI optimism and earnings, but energy and parts of healthcare and finance showed mixed signals. Diversification and attention to the data calendar still matter.
Good point. For investors, it's a reminder to balance conviction in long-term themes like AI with awareness of short-term macro risks, interest rates, oil prices, and those incoming economic prints.
Absolutely. And if you're trading around earnings or macro events, manage position size and expect some volatility. Markets can flip quickly when the narrative changes.
All right, let's wrap up with our quick takeaways.
Number 1. Tech led the rally. Nasdaq up a little over 2%, driven by better-than-expected earnings and renewed AI investment optimism.
Number 2, the Federal Reserve remains cautious on interest rates, which keeps a watchful macro backdrop even as earnings propel some sectors higher.
Number 3, energy slipped on lower oil prices, while healthcare and financials showed mixed performance. So, sector dispersion is wide.
And final reminder, investors should keep an eye on upcoming economic data, inflation, jobs, and other reports. because those will steer market sentiment in the near term.
That's it from us today. Thanks for listening to Alpha Insights. Stay curious and keep one eye on earnings and the other on the data calendar.
Until next time, I'm Jeff.
And I'm Asher. Cheers.